We are continuing our trend of being ahead of schedule. When was the last time you were at a conference that was ahead of schedule? Gives us more time to chat. So welcome back. I hope you're refreshed, you're properly caffeinated and hydrated, and we're going to start our next block of sessions with a case study on aligning financial performance with climate impact. And we are lucky to have Julia Langer, CEO of the Atmospheric Fund, to share our insights. So Julia, I welcome you. The floor is yours.
Great. Good morning. I feel like it's there's a nice natural progression in the way that the agenda has been structured, and so I'm happy to be following sort of the impact panel, maybe the sort of broader context of ESG and thematic and responsible investing. And what I'm going to do is drill down to the climate impact, which was stated as a sort of priority focus for many investors. We're all experiencing this, and how to make a difference with your portfolios, with your investment. So let me change. Do I have a clicker? Here we go. Just a quick introduction to the Atmospheric Fund. We are an endowment. It's a climate agency, as we call ourselves, which is focused on advancing low-carbon solutions in the Greater Toronto-Hamilton area. So sometimes you have to, do some work to demonstrate, de-risk, and help scale. That's the space that we hold on the climate solutions agenda. And so we have a team that includes policy people, communications, we're a grant maker, but also we have an investment practice that is really, I'm gonna sort of focus in on how and what we do, because we are all about impact. So that's how we were created, through legislation. That's the objects are codified in the Toronto Atmospheric Fund Act, and so that's what we're held accountable to for in terms of all of our activities, including our investing. And so we are small. We have a staff of about 35 right now, and so very rarely do we do anything alone. And so one of my reasons for coming here, it's a great group of people who are kind of in this space and who are keen and looking to advance some impact, and you're the people we want to work with, among others. And then more recently, just to orient you, if you come from a place other than the Toronto area, we recently secured an endowment from the Government of Canada, but along with that was endowments for 6 other organizations that are modeled after the Atmospheric Fund, so in Vancouver, Calgary, Edmonton, Ottawa, Montreal, and Halifax. So now we have a broader network of organizations that are kind of getting into the whole impact investing space, including alongside others in their local communities. So let's just talk about financing this transition. This is, we know where we need to go. So, net zero is, and the Paris Climate Agreement really sets the stage. And this has to be operationalized at the international level, at the national level, at the local level, and that's kind of where we start with a bit of a bottom-up perspective on the transition to a net zero economy in our communities. But of course, it all ladders up, so we have to be thinking of the big picture as well as what we're doing on the ground. And what we find is that, and this probably has come up in many of the conversations, in the investing space, there's kind of there's a lack of infrastructure. There's a lack of knowledge, but it all boils down to investor confidence. And so we've really embraced this concept both in our own investing practice, but also when we engage with others, is that we need to feel confident when we deploy our money. And that confidence takes many different forms and can be achieved, in a variety of ways, but we have to keep our eye on that ball. And so what we're going to need in terms of financing the transition to a low carbon economy is we need public money. So the government, both at the federal and the provincial and even at the local level, need to be part of the financing ecosystem. And often they have free money, but they have very cheap or very low cost money. They can have longer terms because they're investing, for a future. And what we really need the public funding to be doing is helping crowd in and de-risk other money. So I just want to frame up that we're not alone, and we can't be alone on this impact investment journey. Philanthropic dollars are starting to sort of come into the market, and so on an investment basis, that can be quite concessionary, or it could be market rate. I mean, it really depends on what the foundation endowment is needing and wanting to do. But there's an opportunity to be innovative in terms of structuring, to be first movers, to sort of pave the way for others to come in, whether that's public or private, to do some syndication. And this is something that the Atmospheric Fund has really, taken a role in, and that we'd love to be playing with others in that space. And then, of course, in the private markets, obviously performance is top of mind, but it's kind of what I call with perks. It's with the impact, and this is what the investment community is looking for. And so everybody has to be part of this stack. So this is kind of one of the fundamentals that I kind of want to put out there, because we're tiny, and so we need to work within an ecosystem. So I wanted to maybe spend a bit of time on, and this won't be a surprise to any of you, very likely, but it's how we layer in climate impact to the investment practice. And so frankly, it's the same. All the principles and all the approaches and all the tools are the same as traditional investing, but we have objectives. In our case, they're low carbon, sort of the climate solutions, but we've talked about housing, children, health, et cetera. So if you just think of what would I normally do, or what I have done in the past, you can't stop doing that, but you have to add your impact. What is the impact that you want to achieve? And so that comes from policy. And there's probably a pretty healthy debate at this stage of the game, because, for instance, one of the panelists earlier talked about having a separate policy. We don't buy that per se. We've just basically said our policy is our policy. We need to advance our mandate. And so what we have in our investment policy is our belief, our solid belief based on data, based on what the market is showing us, and based on who's around the table at our committees and boards, that you will do as well, if not better, by addressing climate risk and climate impact. And so you have to strongly believe that. You can't just make it, another sort of separate little thing. It's like internalize that, build it into your policy, because that is what gives you the permission as fiduciaries to do this impact investing. Without that, you're sort of a bit flailing around on the edge. And that is not confidence. We need the confidence and the belief that we can do this investing prudently according to our mandate under the Trustee Act. Like, this is what we're responsible for. So then you get to, all the basic things like the asset mix. So if we're going to integrate, have impact as part of our policy, where does that show up? For us, it is a cross-cutting objective. But you have to have diversification to do prudent investing. So our asset mix includes fixed income, it includes equities, it includes alternatives, and it includes what we call direct investing. And they're all kind of in we've got a target portfolio. We happen to have on the direct investing side, like a very big allocation. So we can put up to 60% of our $100 million portfolio towards direct investing, aligned with our mandate. And then, of course, you can put in exclusions so policy is policy. It's just layer your perspectives about impact into the policy. And then, of course, how do you implement this? So looking, the risk return objectives are really important. And to align this with our mandate, we have decided that not only do we want emission reduction, but we want to mobilize other capital. And so our decision has been that if we do concessionary investing, nobody's going to think it's a great opportunity for investing their money. We have to have a sticker price that is going to show the broader market that this is a great investable opportunity in low carbon solutions. So we're not a concessionary investor. Now, I'll tell you a little secret, though, that basically even though our coupon or the expectation of return that we set on our transactions, we have a lot more staff and work that we do to get any of those investments going. So, the banks kind of look at us and, like we're managing $100 million and we've got a team of 4. Like, that's ridiculous for a bank, but that's our mandate. That's where we provide some concessionary investment to make it work. And then we're not a venture capital investor, so we're really kind of we invest in things that are proven solutions. So that's the kind of stage, you have to position where your strike zone is. That, what kind of stage of company or project do you want to invest in? And as I said, our preference is to invest alongside others, either formally or informally. We have done syndication, or we do sort of co-investment with others. You can share the work, you can share the ideas, you can share the due diligence. That it makes it fun. I mean, we have to have a little bit of fun while we're doing this as well. And then, of course, a lot of that sort of risk return has to do with, like, what are the security? Like, where is that confidence that you're building into your transaction structure or your investments? And then, of course, nobody can scrimp on governance. In order to be a prudent investor, you have to have people at the board table, at your committees, and in your management team who understand impact from a what's a good investment perspective, because otherwise you are just kind of waving, like, I think you need that belief and you need that expertise. Of course, we have a great third-party advisor. We use Hub Proteus, and they've been fantastic. And our management team, really knows their business. And so in terms of, like, implementation, origination is a big part of our work. I think what's happening a lot in the market right now, and that sort of conversation, the question I asked about, about sort of the aggregation, is people are kind of waiting for deals to come their way. If you have a strike zone, if you have an impact objective and you want to deploy capital, you have to go get the deals. Sometimes they walk in the door, which is great. But if you can really frame up your strike zone and say, we want to fund these kinds of projects or these kinds of companies, then and you go to the clean tech conferences, or make friends with the BDC people who, are working with the small, medium enterprises across the country. This is where you find the great projects and the great companies. And then you can screen to basically say, does this fit our mandate? And then all of the due diligence that comes there. And the due diligence is, a really big piece of this. And I was talking to some of the folks in the hall who have displays and tables. That internal capacity to really drill down and understand, is this a good deal? And a lot of what we do is forward-looking quantification. So, obviously you look at the management, you look at what their, revenues have been, all of that. But really what we have is a threshold in terms of impact. So we don't want to just fiddle at the edges. And a lot of companies come in and say, I've got this great zippity-doo-dah thing that's going to save lots of carbon. It's like, okay, show us the numbers. So it's just as important to quantify and have the data on the financial side as it is on the impact side. And we've had some experiments with working with external service providers on this, and ultimately we brought it in-house. We've got a team of people who really know how to count carbon, because it's about looking at not only the immediate, what are the direct emission reductions, but what's it going to look like in the future? What is market penetration? How is this going to change the game? Will this crowd in money in terms of the delivering the level of emission reduction that is worth investing in? And so, that's kind of another layer of due diligence that a lot of organizations just don't have right now, and that we need to work on together to make sure that it's really robust, because we can't afford, nobody can afford losing money, but, the reputational risk is actually probably worse than the financial risk when it's layered together. And then, of course, there's all the lawyers. There's great lawyers out there, but there's not always, they don't always understand that we're doing this for mandate. They're risk. So it's like you have to actually have some belief and confidence and dedication to advance this, and work with a team that understands both the financial and the impact side. And then, there's always back office. You have to, when you're doing direct investing and not having third-party managers, that's part of the equation as well. I'm going to show you some case studies of projects that we've invested in, but what I think is interesting about the Atmospheric Fund, and we're finding in a lot of, a bunch of other organizations, the panel was really interesting, the first panel, is that we're inventing this. These are our mandates. We need to advance our mandates, and the structures aren't necessarily there. Or they might be there, but you have to adapt them to do the work that we need to do. So addressing the barriers to capital that great companies and great projects have, because we want to do those deals. De-risking, like loan guarantees or insurance products, or, we have to be thinking very creatively so that we can do the deals that need to be done. And that, that's kind of another layer on the investment team. So they have to be, really sort of thinking, how can I structure this in order to make this deal go? And that's about that sort of confidence and belief that you need to move this forward. And then some of the other work that we do, and it's a bit the impact investing team, but also the broader organization, is that you can have the best, whatever, thing that somebody's invented to reduce carbon. But if the policy environment is wrong, it's not going to go anywhere. Like if there's barriers in the building code, or if it's there's procurement problems, it's not going to happen. And so a lot of what we do to make the deals work is we engage in a lot of the policy advocacy to change the rules of the game so that these great solutions flourish. And provide some advisory support on that and sort of bring others into the game. So I'm just kind of flagging for you that, like third-party investment, and you need great managers, and I'll tell you about some of ours, but if you're going to do like that impact and at the local level on the direct side, it's a bit broader than what some of our traditional investing use the same approaches, but you have to sort of think more broadly about what will create success. So just a bit of a profile of how we layer impact into our portfolio. So we have 4 public equities managers, and they've all been selected based on their sort of thematic focus on sustainability, and that we're long-term investors. This climate crisis is not going to be solved in a quarter or 2. Working with really great firms that can move the dial there. We've just invested in alternatives. So one of your sponsors, Connor Clark and Lunn, and IFM, fossil fuel free, really focused on renewables, on efficiency, because like when you think about cities, where do emissions come from? Buildings, transportation, a little bit of waste. And so we need companies who are thinking about those problems and how we can invest in the solutions. Like, who are the great companies that are doing that? I won't go into the holdings, but we've been very happy with both the holdings and the performance that we've received over the years. So on the direct investment, which is, I think, where, it's like the fun stuff, we, because of where emissions come from, have really focused on investment in multi-unit residential building efficiency. So, and it's because half of the population of the city of Toronto lives in high-rise buildings. There's more and more of them being built. They're very inefficient. And so as my previous VP for impact investing, I always found, I'm not a banker, I'm not a finance person really, but it sort of changed my life to have a banker on staff. And basically he was like, if there's energy waste, that means there's money waste. How can I go get that money? And it's sort of like the idea of, if you're a hammer, everything looks like a nail. For me, it seems like bankers are like, everything looks like a deal. So we developed a financial instrument that addressed the problem that building owners have in advancing retrofits. They have very little access to capital, or they don't want to spend the condos don't want to spend their reserve fund, or their social housing that just have no money. And so we just said, okay, well, we want to invest in this opportunity. And so we created a non-debt financing instrument. So we'll provide up to 100% of the funding for the installation of everything from water saving to electricity saving, changing out the heating system, a multi-measure retrofit. And we believe that if this is done properly with good equipment, good engineers, that there will be a return. And so we said we are happy to be repaid as a share of the savings. So we're only paid if the performance is achieved. And the owner, so we usually keep about 90% of that savings, and the owner keeps 10% for all of you investment people. That's an infinite return on their zero capital investment. And then at the end of the term, which is 8 to 10 years, we own the equipment while the project is in place. And at the end of the term, we give them the equipment, and they're the beneficiaries of the savings for as long as the equipment is in place. And so that really, is kind of a bit of an emblematic example of what you have to do to get the impact into your portfolio. You have to understand what the problems are, what the pain points are for your clients, and solve them so that you can deploy money and earn a return and get the impact. So it is kind of a two-way street. And we've financed dozens of retrofits, a lot of them in social housing, cooperatives, condominiums, and some of these organizations, like really, frankly, I've been to their places, their equipment is held together with duct tape, literally. They don't have the money to renew their buildings. These are people's homes. And so this is an investment that both has a financial return, an environmental return, and a social return. We weren't originally looking for the social return, but we find that now we're sort of layering that in increasingly into our transactions. And so the bill savings are in the order of 20, and some of the newer deals that we're doing are even deeper savings. Energy, water, and the emission reductions are all quantified, in fact, like minute by minute, because these projects are all monitored. And the ROI is really decent, like upwards of 200%, with 5 to 8 year payback. A lot of the transactions we're doing now are much longer term because we're going for like close to zero. Like these were, sort of I would call shallow retrofits, our early stage, and we cannot do the newer, deeper projects without public money, the free or very, very cheap public money. But maybe we can sort of crowd in some other concessionary capital from organizations like yours. And then the other side, so that's kind of emblematic of the projects that we can invest in, but we also invest in companies so that have really proven solutions, as I said, not venture. And we can do debt, we can do convertible debt, we can do equity, we have equity-like investments, we can provide guarantees. So we have a wide range of instruments that we can use to advance these investments. And companies include a company we incubated called Efficiency Capital that uses our performance-based contract to finance retrofits. We have a warehouse and a sub-debt line for them that revolves. Project Uncommon, they remine the minerals and materials to make batteries, so not using virgin materials. Kite Mobility is a great company that puts electric vehicles in condominiums, social housing, seniors housing, so people don't have to own a car. So it's on a sort of a personalized car share basis. Peak Power is a company that does renewable energy and EV charging implementation. And we just made a new investment in a company called Assembly that does prefabricated housing crisis. We have to solve that in a low carbon way, and they do that really and they're on a sort of growth trajectory. So, it's interesting, the companies, but each of these required some special structuring, some really aggressive due diligence. We have the quantification of the emission reduction, so that will sort of we'll see how those move through as they mature. So that was my whirlwind tour of the Atmospheric Fund and some of the concepts that we bring to our impact investing practice, which, as I say, are kind of traditional plus impact. And it's important that we all do it well and do it together. Thank you.
Do we have time for maybe one, maybe two questions? Does anybody have any burning thoughts they want to ask? Oh, there's one right here. Please remember to introduce yourself. Yeah.
Probably know me by now. Gina Daya from CAMH Foundation. I'm just looking at your list of grantees in your website, quite extensive. Is there a specific grantee that you would not support? Like, don't bother applying for a grant. Have you ever come across? Because I see City of Toronto, a lot of organizations.
Yeah.
Broad.
Well, I mean, even if projects don't, sometimes you have to throw some spaghetti at the wall and see what sticks. We have a climate crisis, and this is not going to be solved by just the traditional environmental groups. So we have funded unions, nurses, development organizations. So, and we always learn something, even if the project doesn't achieve exactly what, it set out to, you always learn something. And so, I think that there's no organization that I feel is, has not been worthy. And we try to, we're very, just like we're very actively involved in origination of our transactions, we're very actively involved in cultivation of grant applications, so we don't just sort of wait to see what comes over the threshold. We have priorities, we do a lot of outreach and encourage organizations to apply, even if they're not, as I say, very traditional environmental groups.
Excellent. Thank you so much, Julie.
Thank
I
you.
really appreciate you sharing your insights and your experience there.